Welcome back to The Deep Dive, where we unpack the earnings calls that really matter. Today, we're jumping straight into Xylem's Q3 2025, quite a quarter for them.
Oh, absolutely. This wasn't just a beat, it felt like confirmation. Proof that their strategy, especially on margins, is not just working, it's accelerating. So our mission today, break down the numbers, but really get into why the simplification, the execution, and look at what this means for them in digital water.
Yeah, the market definitely reacted. So let's start there. These headline numbers. Just how good was this beat and raise?
It was decisive. I mean, look at the bottom line. Non-GAAP adjusted EPS, $1.37. The street consensus was floating around, $1.23? That's a huge beat. Represents 23% growth year over year, just massive.
Okay, 23% growth. Wow. And was that at the expense of the top line? Did revenue take a hit for that kind of profitability?
Nope, not at all. Revenue actually came in strong too, $2.3 billion. That's up 8% year over year. And importantly, 7% of that was organic growth. So also comfortably ahead of what people were expecting.
Yeah.
And the key thing, they didn't just sit on it. They immediately turned around and raised the full year guidance for both revenue and that adjusted EPS. Shows real confidence.
Okay, so that kind of momentum, raising guidance, it points to strong execution internally, doesn't it?
Yeah.
We've heard about this transformation, the simplification push for a while now. What really clicked this quarter to drive that margin acceleration so fast?
Yeah, that's really the core of it, isn't it? The adjusted EBITDA margin hit 23%. That's an expansion of about 200 basis points compared to last year. You just don't see that kind of jump every quarter.
Yeah.
And it wasn't luck, it was these self-help initiatives really firing.
The 80-20 thing they keep talking about.
Exactly that, the whole 80-20 discipline, focusing ruthlessly on the products, the customers, the markets that actually drive the value. And management specifically said they're moving faster than they even planned on the restructuring side of things. It's just making everything leaner, more efficient.
Right. But efficiency shouldn't just mean cost cuts, right? Did we see any evidence that it's actually helping customers too? Better service?
We did, actually. They pointed to achieving record high on-time performance for some of their key customers. So that's the payoff of 80-20 in action. Better margins, sure, but also delivering more reliably for the clients that matter most.
Okay. And looking across the business lines, demand seemed pretty solid overall. Seems like those big water trends are helping.
Definitely. Growth was pretty broad-based. Measurement and Control Solutions, MCS, saw 11% growth in orders and revenue. That's largely the smart metering boom. And then Water Solutions and Services, WSS, that revenue was up 10% too. So real strength there.
Okay, but it wasn't all smooth sailing. There was that headwind from China they mentioned. They talked about right-sizing. Is that just managing a tough spot, or is something more strategic happening there?
That's a fair question. China was definitely weak, double-digit declines in sales and orders. But the way management talks about it, it sounds like disciplined optimization. They're restructuring significantly, actually cutting the workforce there by around 40%. It's about reallocating resources away from chasing low profit volume towards areas where they can actually get, profitable growth. Pruning, essentially.
Okay, so really prioritizing that margin quality over just raw growth numbers. Which brings us back to the guidance. They raised it significantly.
Yeah, the new full-year outlook's pretty punchy. Revenue now targeted around $9.0 billion, but the real eye-opener was adjusted EPS. They bumped it way up to $5.08. That's up from, $4.76, $4.85 before.
Wow.
And if you kind of back out the math for Q4, it implies management's expecting something like $1.40 in adjusted EPS for the final quarter. That's definitely ahead of where analysts were.
Okay, and connecting strategy to numbers. The divestiture. Selling off the international metering business for $125 million. You have to ask, are they giving up too much revenue there just to make the margin profile look cleaner?
It's the right question. But, listen to how they described it. This segment was doing over $250 million in sales, sure, but the margins were thin. Less than 10% adjusted EBITDA margin at the consolidated level. So by selling it, they lose some top line, but they ditch a drag on profitability and get to focus even more on their strongest hand.
Which is North America, right? That's the edge they have there.
It's all about the AMI market advanced metering infrastructure. Their big differentiator is FlexNet. It's key because it uses the only FCC licensed proprietary bandwidth. That creates a real technical barrier, a moat that others can't easily replicate.
Oh, okay.
And shedding that lower margin international business, they expect it to add a clean 100 basis points to the MCS segment's margin. Just like that. It's a structural lift.
A structural upgrade. I like that framing. And beyond the physical pipes and meters, they're pushing this digital water narrative hard too.
Yeah.
The AI footprint.
Yeah, they're trying to tie themselves into these huge global trends. They highlighted that partnership with Amazon down in Mexico City and Monterrey, using their View Analytics platform for water management. They're projecting it'll save over 1 billion liters of water a year.
That's a massive number and very relevant given, well, everything happening with AI compute demands.
Exactly. Management was explicit about it. This whole AI value chain, data centers, chip fabs, even mining for the minerals, it all needs massive amounts of water, managed efficiently, often reused. They see themselves as crucial for enabling that growth sustainably. Water security for tech.
So let's zoom out a bit. For an investor who's been watching this story, what's the big takeaway from this margin acceleration? Where does it put them versus their long-term plans?
The key thing is they're just running way ahead of schedule. Their original target was, 100 basis points of margin improvement per year out to 2027. Now, for this year alone, they're guiding 140 to 170 basis points.
Yeah.
They're calling it phase 2 of the transformation. Basically, the hard work of simplification is done, the foundation is stronger, and now they can leverage that to accelerate growth things like better enterprise account management.
And they've got the financial firepower to back it up, right? The balance sheet looked pretty clean.
Oh, incredibly clean. Net debt to adjusted EBITDA is down at 0.4 times. That's super low leverage. Gives them huge flexibility. Their priorities are clear. Invest internally first, then look for those bolt-on acquisitions. They're targeting about $1 billion a year in M&A deployment, and then maybe think about buybacks. It's all about quality growth.
Sounds like they're hitting all the right notes for those big secular trends, smart water, analytics,
Right.
PFAS treatment.
Absolutely. These aren't just nice to haves. They're becoming essential infrastructure upgrades globally. It really reinforces Xylem's position as a, quality growth story in the industrial space. Really, the main pushback you hear from analysts now is just valuation. The stock ran up to that 52-week high, around $153, and saw a bit of consolidation. Understandable.
Okay, valuation. That's the hurdle. Which brings us nicely to our segment. This is not financial advice, disclaimer out of the way, but if you really believed this acceleration story, if you thought management wasn't just hitting targets, but structurally changing the game faster than expected, how might you play it?
Okay, not advice, but the thesis would be that the market hasn't fully priced in just how much cleaner and more profitable this business is becoming right now. That guaranteed 100 basis point lift in MCS from the divestiture, plus that implied $1.40 EPS for Q4. Maybe the street's models are still lagging a bit behind the operational reality.
So you need a way to bet that this reality pushes the stock through that recent $153 high. An aggressive play.
Yeah, something aggressive. Maybe looking at long-dated call options, go out to mid-2026 perhaps, target a strike price that's well above the current level, say $160 or even higher. Expensive, but captures that potential upside if the acceleration continues.
Or something a bit more defined risk.
Right, you could look at a bull-put spread. Sell a put below the market, buy one further below, maybe target selling the $160 put, looking out towards the next earnings print. The core idea is the same. You're betting that the combination of that realized margin improvement and strong Q4 execution forces the market to re-rate the stock above that $153 resistance, potentially establishing a new floor over $160. Betting on execution beats valuation concerns.
A sharp take. Definitely grounded in the quarter's results. Great breakdown.
Thanks.
All right, so to wrap up our deep dive, Xylem knocked it out of the park in Q3. A clear beat and raise, driven by, getting their house in order faster than expected. That simplification paying off, plus strong demand, especially in North America, and digital water solutions.
Yeah, it feels like they've really turned a corner. It's less about promising transformation now and more about delivering the results. Phase 1 done, phase 2 growth underway.
So here's the final thought to leave you with. If these internal improvements, this 80-20 discipline, are already pushing margins beyond their 2027 goals now, what's the real ceiling here? Could this operational excellence be creating a compounding effect that the market hasn't fully grasped yet? How much longer is the runway?
That's the billion-dollar question, isn't it? Defines quality growth.
Indeed. Okay, that concludes our deep dive on Xylem's Q3 2025 earnings. Thanks for tuning in. We'll catch you on the next one.